Hi, everybody. This is Patrick Zielbauer from Infinity Futures. Good morning. It's Wednesday, the 19th, 5 a.m. Just wanted to give you a quick update on this little strategy I've been following for about a month now. And let's go back a couple of days. If you haven't seen the other two videos that are up on the page, I recommend you watch them before this one. But basically, just to give you a quick summary, what I've been following is a little strategy that I've been building that has to do with the market reaching or breaching this value area high at the same time as the CCI peaking over 200 here, or breaching the value area low at the same time the market is breaching the negative 200 area down here in the CCI. Okay, so it sounds overly simple. It kind of is, but I feel like there's some validity here, and let me explain why a little bit. But let me also show you the last few days. So it's been a little busy around the office. I haven't had a chance to catch everything I wanted to, but I did have the first day where things just didn't go the right way at all, and this would have been a situation where you'd be in some pain. So here's basically what happened is the other day, this is the 17th, so this is Monday, there were a couple of signals that came through repeatedly. I don't know if they came through on the other indexes or not. I was not watching all of them, but I took a couple. These are hypothetical trades. Okay, so this is a simulator. This is not real money. So bear that in mind, of course. I'm using the Infinity AT platform in Sierra here to do this. So I took a couple of shorts on the Dow, actually three of them. Three contracts is kind of the most I really feel comfortable in any one product with this system in mind, and the market just blasted right through everything. And this is the first day I really saw this happen where there was very little regard for the idea that this could work. So, that's to be expected with any system from time to time. Things just don't work out. The idea, in my opinion, is you can't blow out your account. So, this worked out to like a $1,500 loser altogether, which in my mind would be probably the most that I would be willing to accept, based on the hypothetical balance in my head that I believe would be required to do something like this. And that kind of sucks, but at the same time, that didn't feel like a catastrophe. I've seen people, really destroy their accounts when they get on the wrong side of a trending day. And to me, it has a lot to do with position sizing and just being judicious about how quickly you choose to enter or re-enter the market. There's nothing wrong, in my opinion, with, dollar cost averaging to a degree. It's, historically on a longer time frame, one of the most successful methods of investing, right? So the idea is there. The problem in futures is that there's a lot of leverage, and most people really don't understand or take the time to really think it through the amount of that they're controlling when they put these positions on. So you got to be really careful if you're going to average into a position to try to even out your price a little bit. You can't do it every three ticks or five ticks in the mini Dow. These trades are very, very spaced apart. You can see the hope here was that we were to get a some sort of a sell-off in the afternoon, which just didn't happen. So it's not the end of the world, but the market ripped through that. The value area high kept going higher and higher. I kept getting the short signal. I said, all right, well, I'll take it a couple of times, and then it just didn't work out that day. So no big deal. But that's to be expected from time to time. We can't predict the future here, but you could see I ended up bailing on these up here, and it hurt. It hurt. Um, then I don't think anything happened the day after that yet in the Dow. Yesterday there were some good ones in the Nasdaq, and I think in the S&P as well. You can see. So in the Nasdaq, what we're doing is we're waiting for, again, that market to breach that value area low. This is a very controlled and calm way of trading, in my opinion, because there's not that many signals that happen. So you're not sitting there with the opportunity to make 100 mistakes throughout the day. It feels a little bit you know more calm than even when I'm talking to my own clients about the way they're trading. It just doesn't seem that that my customers are relaxed enough. So of course, there's a difference between paper trading and real trading. There's no one. I'm not. I'll be the first to say that. I mean, you've probably heard me tell you that, before. But there's not that many trades that happen. So I just believe there to be less opportunity to make mistakes. So in this situation, yesterday we had a situation where Let me zoom in just a little bit here. So the first one was there was a signal here. Now remember, these lines shift throughout the day. So even though you don't see the blue background, that doesn't mean there wasn't a signal at that point, okay? Because the value area moves. This is a value area that is evolving throughout the day. 70% of the volume is always going to be between these two lines. So as the market trades up or down, these value area lines will move. So, that's why I like to mark the fills on the chart like this so I can see where I took the signal at. So what happened here was the market broke lower. The CCI hit that negative 200 level down here. You can see at the time the value area was right there, so I put one on. And then the market went up, and then I ended up stopping myself out for 15 and a half points. That was again hypothetical trade, okay? And then later on, same thing happened. The market broke back down, went through the value area. Um, we there was a long one here, and then I took that one off here right at the end of the day, okay? And then in the S&P, I don't know if there was a Dow one yesterday. It doesn't look like it. Let me see in the S&P if there. I believe there was. Yeah. So in the S&P, this was a smaller one. The market broke lower, punched through the value area low. The CCI was making that extreme level that I don't believe can sustain for very long. That's the idea. That's the reason I have a traditional oscillator down here, is that it just doesn't. You don't see that 200 level hit for that often. And then the market went up a little bit. I could have probably gotten a little better, broke down, and took it off. So it was a little bit of fighting back. I mean, not the entire previous day's hypothetical loss, but still an attempt to recover a little bit and still take the positions and not be too squeamish about it. A couple of things that I'd like to note about like the overnight that's happening right now. You're going to see some red arrows down here. These are sell signals. Okay, this means again the CCI is punching up above that 200 level, and the value area high is being breached. So around 1:30 a.m. or so, the value area high must have been here, because otherwise we wouldn't have gotten the signal. Okay, but the market has since traded higher, so the value area is shifting up. These signals really would not be taken. I'm not just saying that with the benefit of hindsight. It's that I haven't automated this process. I wouldn't be here looking at this. I probably wouldn't take anything until I think about 6 o'clock in the morning Central Time, which is in about 40 or about 50 minutes from now, because I really don't believe that this value area has truly been defined until about that time. I'm waiting for things to sort of calm down from the London opening, and they sort of have. But I usually at 6 o'clock is when I start looking at it. I'm getting alerts on my phone all night. I'm not taking these overnight trades because I really want to see an established value area before I start to consider a signal. Plus, as soon as more people start pouring into the market here soon, this value area is going to shift higher really quickly because the volume is going to pick up. So this, and the market's way up here right now. It just made a new high. You could see on the quote board. I saw some alerts. So this value area is going to start to shift higher really, really quickly. I don't want to be following signals down here. I want to wait till the value area expands and then look for another breach of it. That to me is where I believe to be the anomalous event, is when a well-established value area is pierced up to the upside or downside at the same time that oscillator is making a relatively anomalous move. That's the combination of price and volume and just one traditional indicator. The other thing that's happening right now is crude oil is up, made a new high recently. Crude oil oftentimes, as you know, can take the market up with it or way down with it. That's why I have crude up here and I have bonds sort of here as well. That's the red dotted line is bonds, the black one is crude. So one thing that might keep me out of a short position would be if I see crude making a new high at the same time as the sell signal comes in. I might not take that one right away. That's why I really haven't figured out a way to really automate this the way I want. There's still a little bit too much subjectivity. If the market's breaking lower and crude oil is breaking with it or driving it lower and it rips through that value area and that CCI triggers, I probably will not take the long right away until maybe it looks really overextended. Because crude oil will just rip right. If it rips lower and people get nervous about the stock price of major energy companies because crude is breaking, it doesn't matter what the value area low is. It's going lower. So that's why I have crude, and I like to look at bonds here as well to see that inverse or related correlation. So the other thing too that I realized that you might want to avoid if you're doing something like this is why it's good to look at all three indexes. Like let's say the market is going lower and all three of the markets are going lower, and you see signals all at the same time on all three of these indexes, you may want to back off a minute. A lot of times I've seen that this works the best when one of the indexes triggers and the other ones don't. It's kind of like they're out of sync and they're trying to get back in sync. If all three break lower and rip through that value area low at the same time, and that CCI is way below, negative 200 all at the same time, that indicates to me, all right, there's true downward pressure. All the indexes are getting slammed heavily at the same time. Maybe you stay out of the long side until, again, you get the feeling that things look really overextended. So that's something this is an evolving process here, and I feel like that's something that I would be watching for. So in summary, if you're looking for a long or a short using something like this, you may want to consider being a little bit more careful if you see all of these triggering at the same time, because that could indicate a more aggressive move, and you might not want to step in front of that. Because after all, this is a bit of a counter trend strategy. It's sort of like a reversion to the mean, type strategy that combines, again, one oscillator, a couple of, price and volume areas, and then, a couple of correlated markets. So it's interesting. I believe there's some validity here. These are hypothetical, trades, so it's not the same as real money. Okay, I believe that 100%. That being said, if you feel like you're looking for something that you can experiment with that might have, some basis in reality, it's not going to require you to trade, 100 times a day. This might be something to explore. I've had a lot of conversations with some of my favorite customers about it, and I think that maybe this could help some people who are struggling a little bit. So hopefully you find it useful. If there's anything that I can help you with, or if you'd like a copy of the chart book so you can use it on your own, let us know. I'll send it over to you. Just email me or your rep in our office. And just remember that if you're in a different time zone, that my charts are set to 1700 and 1600 for start and end time. Okay, that's Chicago time, so 5 p.m. until 4 p.m. the next day. That's particularly important because I've got studies that are calculating like the daily open, high, low, and close and stuff, and you really want that to be your time settings to be accurate, so those values are accurate. Okay. All right. Fantastic. Thank you for listening, and good luck to you. Have a great day.